Let's look at an example of a finance lease from both the lessee and the leasor's perspective. Rand Medical manufactures lithotripters. Lithotripsy uses shock waves instead of surgery to eliminate kidney stones. Physicians Leasing purchased a lithotripter from Rand for $2 million and leased it to Mid-South Urologist Group, Inc. on January 1st, 2018. So first, let's identify the lessee and the leasor. The leasor is Physicians Leasing, and the lessee is Mid-South Urologist Group. Now, the lease description says that the quarterly lease payments are $130,516, each payment is due at the beginning of each period. So, in other words, this is a annuity due because the timing of the lease payment is that it is due at the beginning of that lease period. The lease term is for 5 years, which equates to 20 quarters. There's no residual value and there's no purchase option. The economic life of the asset is 5 years. The implicit interest rate and the lessee's incremental borrowing rate is 12%. And finally, the fair value of the asset is the $2 million, which is the price of the asset itself. How should this lease be classified by Mid-South Urologist and by Physicians Leasing? So let's start with Mid-South. Is this a financing lease? Well, remember the 5 criteria. Number 1, does ownership transfer? There is absolutely no mention of ownership transferring to Mid-South at the end, so Physicians Leasing will get the equipment back. Number 2, is there a purchase option where the pricing makes it almost a virtual certainty that it will be exercised? In other words, is it a bargain price? Can you buy it for less than fair value? And is it pretty good chance, or almost certain, that you will, as the lessee, exercise it? Absolutely not. There is no purchase option mentioned here. Okay, so that brings us to the 3rd criterion, and that's the economic life check. Basically, what that states is if the lease term is substantially all of the economic life of an asset, then it is a financing lease. Well, is that the case? Well, the lease term, is 5 years, and the economic life is 5 years. So, the lease term is 100% of the useful life of the asset. So that is substantially all. Now, some guidance states that 75% rule here, whereas if the term is 75% or more of the asset's life, then it's probably a capital lease, or a financing lease. But the actual statement is if it's substantially all. So yes, we do have a financing lease. But really quick, let's just do let's talk about the last 2 criteria. So the 4th criteria is the present value of the minimum lease payments substantially all of the fair value of the asset. So let's calculate the present value of the periodic or minimum lease payments. Periodic lease payments, minimum lease payments. All right, so the periodic lease payments here are $130,516. And we have to find the present value of this. So basically, we're going to use the tables because it's quicker here. And we're going to look up the present value factor using the present value of an annuity due. It's annuity due again because the payments are at the beginning of each period. And we're going to look up N is 20 because there's 20 payments over 5 years. There's 20 payments. And then I, well, it's a 12% per year rate. But remember, since it's quarterly, we have to bring that down. So N20 I equals 3%. So if you go to your tables there and look that up, you get 15.32380. So again, just go to the present value tables that we use in class. If you're not in the class, you're watching this from some other source, you can look up the PV tables. This is the PV of an annuity due because the payments are due at the beginning. And when we multiply that out, we basically come back to that $2 million there in fair value. So in this case, it is rounded a little bit because PV factor here is rounded to the 5th. So it might be a little bit off, but rounded we do get the $2 million. And that lets us know that it is 100% of the asset's fair value. So the present value of the lease payments are 100% of the fair value of the asset. In other words, it's substantially all. So we also meet the 4th criteria. Now the 5th criteria states that if the equipment or the asset is of such a specialized nature that no one else could use it, then it's a financing lease. Well, that's not the case here because anybody that does the shock waves for the kidney stones could use this actual equipment. So we know that the 5th criteria is not met. We only have to meet one of the 5. Okay? So this is a financing lease. So now it says, oh, what about physicians? Same concept. It meets the criteria. It is a financing, lease, but this is a sales type lease to the lessor. It's a sales type lease with no selling profit because physicians is the lessor. They bought it for $2 million, okay, which is substantially equal to the fair value of the asset. So since the cost and the fair value are the same, there is no selling profit. So it's a sales type lease. It is a financing lease, a sales type lease, but there is no selling profit there. So let's do the journal. So prepare the appropriate entries for both Mid-South and physicians. So let's start with Mid-South. So we're going to do the lease E first. So we're going to do the Mid-South urologist first. In that, what entries would they make? Well, first off, when did this begin? It began on January 1st. So on January 1st of 2018, that would be our first entry. What would the lease E record in their books? Well, it's a finance lease, so they're actually treating it as if they're purchasing an asset. So we're going to record an asset. Now, we wouldn't just put equipment on there. We're actually going to call it a right of use asset, a leased asset here, so that people know this is not one we've purchased. It's a right of use asset when we look at our books. And we're going to pull that in. Now, when we do this, we always carry the asset at the present value of the minimum lease payments. So in this case, it is $2 million. But please note, that's not always the case. Here it is because the present value of the minimum lease payments is $2 million. So just make a note that when we record this asset, it is always recorded at the PV of the periodic lease payments. Okay, so we've got to be careful with that. Pay attention. Here it is $2 million. That happens to be the fair value, but it's only because those two numbers happen to be the same. And then we need to record the payable. It's similar to recording a note payable, but we're going to call it a lease payable. So we almost treat this as if we've purchased the asset by financing it in this case. So it's a lease payable. All right. Now, what else happens on January 1? Well, January 1, remember we make the first lease payment because it says they're due at the beginning of the period. So when we do that, what happens? Well, since it's at the beginning of the period, has interest had time to accrue? The answer is no. No interest should accrue, so that first payment is going to pay off just a portion of that lease payable. All of it goes to pay down our debt, so to speak. Just like if you make a down payment on a car when you sign a note. Then, what else do we need to hit? Well, we need to hit cash because we had to make the payment of $130,516. Now, any more entries that need to be made in January? Nope. So let's move on. Next one, it says to make them through the first payment, so April, or second payment actually, since we had that first one. So April 1st of 2018 would be our next payment. Now, what are we going to do there? Well, again, every quarter we're going to make that same payment of cash of $130,516. The difference between the April entry and the January entry here is the fact that now interest has accrued. So not only are we going to reduce the lease payable, we also have to record the interest expense on the lease payable. Okay, again, it's sort of like a note. If you did an installment payment, you pay off the interest that's accrued to that point. So how do we do that? Well, we need to calculate the interest expense and then back into the lease payable. Interest expense is calculated on a lease by taking the carry value of the outstanding balance of the payable times the rate times time. Again, just like a note payable, the principal balance times the rate of the note times time, except this is a lease. So what's the principal balance at this point? Well, we started with $2 million, but didn't we pay a portion of that payable off? We did. We paid $130,516 of that off. So we need to do that and then multiply it by the periodic interest rate, which is 3%. Now, the other way we could actually do that 3% is the 12%, so you can multiply it times 12%, then times, then multiply it by our terms. Well, how long has passed? Well, January, February, March. So 3 months, so 3 out of 12, which would imply the quarterly payment there. Okay? So the lease payable goes on. The interest expense, that way, we already knew that the interest was 3%. So let's just go back to 3% because that's got the time already taken into account. And when you do that, you see the interest comes out to $56,085. Now, if that's the portion that goes to interest, the remainder would go to the lease payable. So 130 minus the 56 would indicate that $74,431 would go to the lease payable. So that's the entries that would be required through April on this lease. Now there's one more thing I do want to talk about, and that's going to be the amortization expense. Remember, as the lessee, at the end of the year, we would have to do the amortization expense. So just make a note of that. We didn't go all the way through December 31st. But if we did on December 31st, and I'm going to delete this out, it's not something we need to record, but we would go in and do the amortization expense. And we would get that by taking the asset's life, and we would divide it by the 5-year term. And that would give us our amortization, and then we would reduce the right of use asset. Okay, and the value. Again, I'm not going to do the full entry. I just wanted to remind you, in a lease, from the lessee standpoint, we treat it as if we own it, so we do have to amortize this asset over its life. There's no residual value, so we take the full amount divided by 5, and that's the amount we would recognize each full year that we had this leased asset. Okay, so I'm going to back off and delete that because clear that. Because we don't actually need it in this problem. It doesn't ask for it. I just wanted to make a point of that. Now remember, these were the lessee entries. Now let's go back and do the January entries, but we're going to look at it from the lessor standpoint. So we're going to change gears and actually look at it from Physicians Leasing Company's aspect. For the lessor, this is a sales type lease, but now notice there's no sales profit. Why is there no sales profit? Because the cost to Physicians, they paid $2 million, the fair value was $2 million. Therefore, they're not going to make a profit on the difference between the cost of the good and the actual sales price or the lease price. Okay, so this is a sales type with no sales profit. So what does the lessor do? Well, in this case, since there's no sales profit, what they would do is they would record the lease receivable. They also record it at the present value of the periodic payment. So the PV of the periodic or the minimum lease payments. Now, what would be the difference? Well, since we're both using the same payment, there's no residual values to deal with. We both have the same rate, and we both have the same terms as far as time, which always is the case. We would actually record this lease receivable at $2 million. Now, if there was an unguaranteed residual value or if the rates were different, we may have two different recorded values there. But since both is the same, so all the components of this lease are the same between the two parties, both would record it at the PV of the periodic or the minimum lease payments. And then we're going to credit the actual equipment because we're getting rid of that asset, so to speak. It's coming off our books. We no longer have it in our possession. So there's no sales profit here, so we don't have to worry about sales revenue, cost of goods sold. We simply record the equipment that way. Then we also have to record this lease payment. So we're going to receive the cash of $2 million. I keep hitting M there, sorry. And then we are going to also show that there is a reduction in the lease receivable. Since the rates are the same and there's no residual value, both parties mirror each other on this lease. So notice, here they have the payable and the asset. Here they have the receivable and are removing the asset. Here they received the payment, or they made the payment and reduced the payable. Here they received the payment and reduced the receivable. Oh, why did I put $2 million? Sorry. Wow, that's a big payment. What would be the point in doing the lease? So 130,516. Again, I was talking instead of paying attention. So that would be our lease payment. Again, sorry for any confusion there. Now, what would happen on April 1st when we did the next payment? We're going to run out of line, so I'm going to add one. My apologies there. So go in April, we're going to again receive a payment, and we're going to receive the payment for $130,516, just like before. The difference being now time has passed, so interest has accrued. So again, notice that first payment went all the principal because no time had passed, so no interest could accrue. Second, we had the interest expense on the leasee. Same concept here. We're going to reduce the lease receivable, and we're also going to recognize the interest from that time period. Now, since the carry value is the same and the interest rate are the same, the actual interest piece would be the same for this. So the lease receivable would go down by $74,431. And the interest revenue would also go up then, but it would go up by the 56,085. And it would be calculated the same way. The carry value of 2 minus the initial payment here of 130 would give us our carry value currently times the 3%, which is the quarterly interest, and that would give us the 56,085. Now, the next piece of this puzzle says, well, what if? What if Mid-South leased it directly from Rand? So notice Rand is the manufacturer, so he's going to have a different cost basis than Physicians. So it tells us the machine was produced at a cost of $1.7 million. Still a sales type lease, but here's the difference. Now we're a sales type lease with a sales profit. So that changes only the initial entry. Well, what do I mean by that? Well, when you go in for Rand, so we're only going to look at Rand because Mid-South, it does not alter theirs at all. Makes no change to them. But Rand now is the leaseor, so we have a different leaseor, and the leaseor has sales profit. So we still record the lease receivable at the $2 million, because that's how much, again, there's that crazy M. So at the $2 million, because that's how much we're actually going to recoup. Okay, present value of the minimum lease payments, that's what we're going to recoup over the life of the actual loan, so to speak. So lease receivable. Now we still need to get rid of our equipment, but notice our equipment didn't cost us the full $2 million. Our equipment only cost us $1,700,000. So that makes a little bit of a difference in how we're going to pull this in. So what do we need to do then? Well, when that's the case, what we have to do is we have to record the cost of goods sold at the $1,700,000. And we have to show that we have sales revenue for the $2 million, so that we actually balance out there. So notice, when we have this type of entry, we have to record the sale. So if it helps, you can also look at it like this. So let's just move these around a little bit to give you a better visual of it. So you can go ahead and do the $2 million. So it's very much like a sales entry we did when you do perpetual inventory. You record the actual cost of the goods sold when you do the sale. So if you flip those, you can make it look like that. Now again, either way is fine. I'm just trying to give you sort of a visual of what this really looks like. It looks like we're selling a product and we're recording the cost of the good that we sold. Now, beyond that, what's the difference between a sales type lease with selling profit and without? Nothing else. Just the initial entry is different between these two items when the selling profit takes place. So then on the 1st, 2018, we would still do that same receipt of cash and credit the lease receivable. And we would do that for that first payment because no interest has accrued at that point. If I can find my comma, there we go. Then on April 1st, very much the exact same entry. We're going to receive that cash payment of $130,516. See how good my memory is. The lease receivable, without looking back, was 74, was it? 74,431, I believe. And then we had 56,085, and that's going to be our interest revenue. Okay, so calculated the same way. Notice when we scroll up here, these two entries are the same because the only difference in this type of lease is whether or not we have the selling profit. Here, when the cost equals the fair value, there's no selling profit. Here, when the cost is less than the fair value, then we do have a selling profit, so it creates a little bit difference in the entry. So hopefully this has helped clarify the leasee side when there's a sales profit not, and also just reviewed the leasee side, but then clarified the leaseor side, whereas there's selling profit or not selling profit. I said that a little backwards there. Hopefully that helps.